Episode 4. The 20% Zone, where the auction chooses a side. If equilibrium is the center of gravity, the 20% zone is the first real decision point. This is where most meaningful trades actually begin. And it's also where most traders are either too early or completely unaware that anything important just happened. Most traders are trained to care about highs and lows. VWAP, 50% retracements, premium and discount. Those ideas aren't wrong. They're just late. The 20% zone represents the earliest place where the market stops rotating and starts testing acceptance. Think of it like this. Equilibrium is agreement. 10% is a probe. And 20% is the first real decision attempt. At 20%, the market is no longer asking, where is fair value? It's asking something very different. Will participants continue doing business away from fair? And when price reaches the 20% zone, only two things can happen. Either price is rejected or price is accepted. Rejection looks simple. Price reaches the 20% zone. It fails to hold. And it rotates back toward equilibrium. This isn't a failed setup. It's the market saying, not yet. Most chop lives here. Acceptance looks very different. Price closes beyond the 20% zone. It holds there for multiple bars. And pullbacks no longer return to equilibrium. This is the moment the auction chooses a side. Not a breakout. Not momentum. Acceptance. This is also why Harmonia cares about closes, not touches. Touching the 20% zone means nothing. Anyone can push price there briefly. Acceptance requires time, follow-through, and a willingness to transact away from balance. That's why Harmonia waits for multiple closes beyond 20%. Not because it's conservative, but because false expansion is common. The most common mistake traders make at the 20% zone is simple. They either fade it immediately or they chase it immediately. Both are wrong. The correct mindset is to observe first and participate second. The 20% zone is not an entry by default. It's a filter. It tells you whether continuation is even possible, whether fading equilibrium still makes sense, and whether higher targets are even unlocked. This is also why most real trend moves start at the 20% zone, not the 50%. By the time price reaches 50%, acceptance has already happened. Risk is worse, and reward is compressed. The cleanest continuation trades usually follow the same sequence. Acceptance at 20%, a pullback that holds above it, and then expansion toward 50. That pullback is where professionals enter. Not at equilibrium, not at the highs, but at confirmed structure. And to be clear, the 20% zone is not a guarantee. It's not a breakout signal, and it's not directional bias. It's simply the first place the auction can prove intent. And when it fails, that failure itself becomes information. This is why Harmonia is built around this level. Most indicators try to predict. Harmonia waits for the market to declare. The 20% zone is where failed auctions are born, where turtle soup setups originate, where rotations turn into trends, and where chop exposes itself early. It's not flashy, it's honest. Now you understand where balance lives and where intent first appears. The next question becomes obvious. What happens after acceptance? Because acceptance alone doesn't mean the move will go far. In the next episode, we'll break down the 50% and 80% zones, not as targets, but as probability, and explain why most traders misunderstand what actually happens as price moves deeper into the auction.